Okay, and so now that we understand breaks of structure, we have our structure mapping down, and we have an understanding of ranges, we now have a new perspective on highs and lows in the marketplace. And this allows us to follow a trend in any market on any time frame, any instrument. It doesn't matter. This is all happening on any time frame and on any chart. We can now use this framework to mark higher highs and higher lows and lower highs and lower lows. And so now what I'd like to do is just run through a quick example of understanding higher highs, higher lows, lower highs, and lower lows. And so I want to do that just in the same stretch that we've been analyzing here on AUD USD on the 5-minute chart. And yeah, just kind of apply everything that we've learned over the last introductory lessons on candlestick mapping, break of structure, ranges, all that, and then add in higher highs, higher lows, and we'll try to find some lower lows and lower highs and go from there. So yeah, we have a little pullback here and continuation. And so we can mark this price here, or this point in price, as a lower high. And price then continues down and breaks structure, at which point in time, as soon as we start to see this pullback, we can mark this as a lower low. Price then gives us a change of character here, which we'll go over later on in different topics or in different parts of this lesson. So I'll just skip over this price action right here because this is actually a reversal pattern, and we can see that price gives us a higher high at this point and a higher low at this point. And this area right here, we know that that's the case because of this breaker structure. So I didn't actually have that marked on, but because of this breaker structure right here, this is now a higher low, and then this would become a higher high. And then we also have a higher low down here. Price continues on up. Price retraces down into here and continues on up, and it doesn't actually break structure until over here at this point in time, which that then becomes a higher high. And there are breaks of structure in between this range, but now I'm getting into mapping a little bit more of the swing structure. So you're not wrong if you're looking at the chart here and saying, okay, at this point in time, this was a break of structure. And then at this point in time, this was a break of structure. And then at this point in time, this was a break of structure. If you're looking at the chart and you're seeing that, that is totally okay. And there's absolutely nothing wrong with you seeing it that way versus me marking it here. I have come to realize that people who mark their structure like this are better scalpers than they are swing traders or longer term traders. I'm saying this as I mark up the 5-minute chart, which you'll learn more about timeframes. If you're totally new to this, please do not let what I'm saying overwhelm you. But I just want to point out that however you map this is totally fine, and however you perceive this is totally fine, as long as you do that consistently throughout your trading. And later on in lessons, I'm going to talk about and do videos on how what of this actually matters, and how to combat the difference between me and you, because we're always going to after this course, if you and I are both trading AUD USD a year from now, there's going to be times where you have a different analysis from me and your breaks of structure look a little bit different. But what really matters is that you are doing it consistently in a way that makes sense for you, and that you keep that consistency throughout all of your trading. And so if you're going through these lessons and through the homework and you're marking stuff differently than what other people are or what I'm marking it as, then first of all, you just need to understand that that's totally okay. And second, if you have tighter breaks of structure like this, you probably are going to end up being a better lower time frame trader. So like a scalper, someone trading the 1 minute, the 5 minute, stuff like that. People who see breaks of structure like this that I just mapped are either A, going to be way more experienced traders, or B, going to be a better swing position trader or longer term trader. Not necessarily a swing trader, but longer term trader. So you would be capitalizing on moves that are bigger pullbacks. And so both of those are totally okay. And it just matters, like I said, on the way that you consistently apply it to your charts. So to continue on with the video, we do then have a higher high formed here. And at this point in time, price is actually, this was this last Friday, yesterday. And so price at this point in time, we can assume is going to pull back down into this newly created range and trade to make a higher low, and then continue to make a higher high until it doesn't. And so at this point in time, I'm not going to mention the fact that, any other concepts that make this less likely to happen because of like higher time frame analysis and stuff. We just can assume that without any other confluences that this is what's going to happen. And so just to mark this really quick, do a higher low right here. And yeah, that's how we can now use breaks of structure and candlesticks and all that to create different higher highs and different higher lows, and to actually mark the trend and the way that the market is trending in any market in any time frame. And so I'll leave the homework below this video. And if you have any questions on this, be sure to ask in the group. Otherwise, yeah, I think that once you go through charts and you apply this to your charts and through a few different time frames, you'll start to see the power that this provides, because you can find trending markets immediately without having to guess with any kind of indicators, without having to wonder, like how long or how far back in price on a chart do I need to look at to find a trend. Because right now on this point in time on this chart, this is a bullish trend because it's trending bullish, because we use our very simple break of structure to understand that until it doesn't. Now, if you come over here and you're only looking at this time frame and you're only trading the lower time frames, now this becomes bearish because it's a break of structure right here, break of structure right here, and that would be different, a different trend. That would be a bearish trend. So you'd have lower highs and then lower lows. And so let's just do that really quick, just to show the point of this, that it really just depends on where you're looking and what price action you're looking at. Let's get rid of our red tool here. And let's say you came up to a chart that was like this, without zooming out, without knowing what's happening on the higher time frames. This market right here at this point in time is trending bearish. And so we have our break of structure there, and then we have our break of structure here. Let me get rid of this from our previous examples. And we can see that here price has a lower high at this point, and then we get the break of structure right here and the retracement back up into that range. And so at this point in time, this would be a lower low. And then we have a lower high again right here. And then we have a lower low again right here forming. And price, the expectation of this, without taking anything else into consideration, the expectation is that price broke here. So it's going to trade back up into this newly created range at some point in time, and then continue on in the future at some point in time, at which point we can then expect a lower high to be created and then another lower low to be created. And we can expect that to continue until it doesn't. And so as we go through this course, we'll add in more and more confluences to help us accurately predict when the market is going to reverse and when the trend is actually likely to change again. And so I'll leave this video here, and we'll see you in the next one.